this is where it gets interesting, because for the last couple of months, in fact, especially the last couple of weeks, the debate on if inflation is persistent has been nonstop. You have economists that are saying, hey, the information that you're using is lagging, it's not correct, it's not in real time, and now we're going to create other issues in the future. And you have the other economists, the other people on the other side of the fence that are like, no, affordability is still too outrageous in the United States. The cost of goods and services are way too high, and we still have to put more pressure on this so that we stop spending and bring down demand significantly enough to lower prices. And I will say that anecdotally, working in real estate, buying a home right now is just not affordable for the marginal first-time home buyer, right? People who are on the lower end of the income spectrum that don't have a ton of assets. I mean, it has become an unaffordable purchase. And for me, that makes it super sad. And this last 2 weeks, we have received so much conflicting information. In fact, since April, really, we have started seeing these corrections from the Bureau of Labor and Statistics, which provides a lot of the economic markers that the Fed is using to gauge monetary policy. And so we have to break down like what really happened the last 2 weeks, because it's important, because I think it's going to positively impact mortgage interest rates. And so yeah, we're going to break that down in today's video. So if you're new to the channel, my name is Lizzie Hofer. I'm a residential loan officer at Cross Country Mortgage. I like to teach practical money tips so you guys can make a smart home purchase. Okay, so I know what I'm saying is a lot, so bear with me. And if you have any questions, don't hesitate to leave them in the comments below. I'm going to answer them. Essentially, what impacts mortgage interest rates is a security called mortgage-backed securities. It's an investment, kind of like a bond. It pays back returns on pooled mortgages, and people invest in mortgage-backed securities similar to a bond because you know what to expect in terms of a rate of return. It's relatively low risk, although it doesn't pay as high as other investments like the stock market. And so when the economy is volatile, people tend to pull their money out of the stock market to put in vehicles like mortgage-backed securities. Mortgage-backed securities have been a bit controversial because people don't feel like they're a good long-term investment, because they believe that there will be a massive wave of refinances once, the economy has to be stimulated. The mortgage-backed security market has been very fickle depending on any kind of economic news. Just know that when there is strong economic news in terms of jobs, in terms of spending, mortgage-backed securities are hit pretty hard. And whenever there's negative news like higher unemployment, higher job losses, lower job creations, any kind of negative news with the economy, we see a benefit to mortgage-backed securities. That's generally the rule of thumb. Now, albeit it has never been in my whole career as volatile as it has been in 2023. That's the general rule of the game. Now, why that's important is because on a monthly basis, we get inflation reports and we get job reports from the Bureau of Labor and Statistics. And since April, they have kept making these pretty significant revisions to both reports. And it's been really difficult for analysts to gauge the trajectory of either of these moving items. And so in April, there was a big one made to the shelter costs when it came to the CPI report, which is the Consumer Price Index. And that's the big one. That's that big phone survey where they call a bunch of people and ask what they're paying for a variety of different goods. And so that one really hurt. And so we were expecting way lower inflation numbers come May, and they were slightly skewed since then because of those corrections. And now recently we just got a new correction with the number of jobs that were created. Now, why this is super important is because there's going to be another Fed meeting to discuss if they're going to raise the Fed funds rate. And we know that the CPI data is lagging. Now we are getting these corrections in employment reports. And so it would show, right? We have enough support, I believe, to show that the economy is no longer growing at this rapid pace, and we are now starting to see the effects of all of their fiscal intervention. And so if this is the case, we should start seeing mortgage-backed securities improve and mortgage rates lower a lot sooner than anticipated. And as of recent, right, there was some speculation that we might see a peak in interest rates, all the way towards November, and then start seeing a correction towards the beginning part of next year up until quarter two. but that might come a lot sooner, right? And so just know that mortgage-backed securities are very, very dependent on what happens with the economy. So this is good news for people who've been waiting for lower rates. I will tell you though, because one of the biggest questions I get is like, when's the best time to buy? And I always tell people it's impossible to time the market. But when you look back historically, the best time to buy is when there is the lowest amount of demand. And that's because you pay the lowest prices. Now, albeit right now, you're gonna pay high mortgage interest and you're gonna pay high costs in terms of discount points. Sellers are also more willing to give you concessions to offset, and there are temporary buy downs to help you with mortgage payments in the short run. But the best time to buy is when the least amount of people are interested, and that would be now as interest rates approach their highest rates in the last 20 years. So when we look back at this time, my professional opinion will be that this is the lowest price that a consumer will have paid in terms of the cost of a house, like what the price is that they will be paying, right? There's 3 to 5 million qualified buyers once interest rates drop into the low 6s and the high 5s. And that's just gonna create a whole lot more demand, which will raise prices. In fact, even with the super high interest rates that we have, because there is a lack of inventory, we are still showing every like real estate report is showing appreciation of like 0.5% to close to 1% month over month. And so home values are still growing despite high interest rates because people just aren't willing to sell their houses with the low interest rates they have. So just know we will have increased inventory if interest rates go down, and we will also have increased demand. So if you're looking to get a deal in terms of price, now might be the best time based on the information we have today. So to wrap this all up, pay attention to the jobs reports, headlines that you're seeing. We're gonna get a big one on Friday. If we get a bad employment report, I expect interest rates will improve. Pay attention to anything inflation. I think that we're really gonna start seeing significant declines in inflation. And pay attention to any time they say the Fed is going to raise the Fed funds rate, because this would be bad news bears for the economy. These 3 things are impacting your mortgage interest rate. Let me know what questions you have in the comments below and any future video ideas you'd love to hear from me. All right, guys, until next time.